It is a pretty great day to be a Lemonade shareholder. Up almost 25%. Are the results really that good? Should investors be thinking about buying this stock? We're going to take a look at that. Before we get into the details, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go check out our special link. It's fool.com/unscripted. Go to that link, check it out. You can get access to The Motley Fool's 10 best stocks to buy right now every month. Go check it out. You'll be glad that you did. All right, let's get to it here. So what's driving Lemonade stock up? The growth story continues to play out. 17% customer growth, over 2.3 million customers now. Premium per customer continues to grow. It's at the mid-single digit rates. That's fantastic. As a result of those two numbers, in-force premium, almost $900 million. It's a reminder how small Lemonade still is as a business. I want to go back to net loss ratio. Remind everybody that it's been year and a half ago, the loss ratios were substantially higher. What is gross loss ratio? It's really what's left over from premiums after paying claims. It doesn't include operating expenses. The inverse of that 73% would roughly, that's like the gross margin is a way to think about it. That is the way that Lemonade breaks it down. I want to stay on this loss ratio for a second. This is really important. This is a great number to see. And I've been saying for 2 years now, this is the thing that we need to see Lemonade be able to demonstrate. They need to be able to demonstrate the ability to underwrite insurance well. And well, they're showing that. That's really, really good for the business. There's another metric that they've been talking about, and that's net cash flow. Something they've just started talking about in the past couple of quarters. You always have to be careful when a company says, oh, hey, here's this new metric that we're going to be talking about. But the bottom line is that this is still a GAAP loss business, still generating large losses. Insurance is really interesting, though, the way you recognize revenue. You may have had the cash flow already come in for policies. So you've got the cash, but you haven't recognized all the revenue because if somebody pays for a policy for a year, you can only recognize the portion of the policy that has gone by. So 6 months into the year, if it's a $1,000 policy, you would have recognized $500 of that policy in revenue. You're going to hold a liability on your books for unearned premiums because you already have the cash, right? That cash offsets the liability. But if the customer cancels that policy, you have to give them some money back. So there's that liability that's there. So what happens is as they're earning the premiums and the revenues haven't all come in, but the cash flows are coming in, this is a way to kind of show, hey, we're bringing in cash. So I think if you combine that net cash flow positive with the vastly improved gross loss ratio, I think this does support that the business is certainly, that's a real positive. Now, everything is not perfect with Lemonade by any stretch. Continues to lose money. The losses are actually growing. The premiums have continued to come in. That in-force premium number continues to grow. That's the total dollars in premiums that it's earned for policies that are in force. Unearned premiums, we talk about that. This is premiums that they've collected the money for, but they still haven't provided the insurance service for the length of time. Eventually, this liability will fall off the books as they recognize the revenue for the rest of the policy. So that's some positive stuff right there. But again, we got to look at the financial results here. We're going to take a look at net income and total operating expenses. Again, red, net income. So net losses, the losses have consistently grown. Now, the latest quarter is not reflected in this. I will tell you this, the numbers have actually deteriorated. We'll explain why in a minute. Operating expenses, this is the key reason why. But again, we'll take a closer look at the Q3 numbers and break that down. But again, the key is we've seen operating expenses continue to rise and rise and rise. Now, to a certain extent, that's offset because a lot better job with underwriting, moving from gross loss ratios in the 80s and even in the 90s in a couple of quarters down now to the mid to low 70s. That's fantastic because that frees up money that's left over that you're not paying to cover claims that you can use to fund your operations. But it's still a pretty big delta between what they're bringing in and the revenue they're recognizing and covering their expenses. We'll start here with the operating statement from their latest quarterly results. Strong revenue growth, revenue recognized 137 million, just about. And then expenses, 202 million. I really want to point this out. Expenses went up substantially year to date, first 9 months of the year, about $39 million increase in total expenses. That is a significant increase. And here's the key. You start digging through Your net earned premium went up a lot more than your loss and loss adjustment expenses. Your underwriting is better. Now, some other couple things. Sales and marketing, this is the big one. Sales and marketing is up substantially. This is the thing that's driving your expense. If you look at their other expense lines, technology and development, general administrative expenses, those are actually coming down to flat. So that's good. What's the takeaway here? Lemonade is really spending a lot of money to continue to grow, right? It's accelerating its losses by spending to continue to grow. Now, why is it important? Because when we flip over to the balance sheet, this is where we're going to see the financial impact slacken the system, so to speak, to get the business to where it's going to be more stable. This is a year over year through the first 9 months of the year. Total assets are up about $190 million. That's good. You got an extra $190 million sitting on your books. Let's move to liabilities. $305 million roughly increase in liabilities. So $190 million more in assets. Liabilities increase more. That's not great because that means you're kind of chewing through your existing asset base to fund the business. We look at the investments in cash. We're looking at what, $980 million versus $940 million. So that number's up $40 million. That's positive. But then we look at unearned premium. That number increased $100 million. So again, we've got the cash for it, but we still have to recognize the revenue for the premium that we haven't earned. Or if the customer cancels, we're going to have to give them some money back. This number, I like to think that this number should be larger. It should have increased more than this number did year over year. What does that mean? We know that it's spending a ton of money to grow. That's where that excess between unearned premium and cash and investments on the balance sheet has gone. It's gone to grow the brand, to acquire more customers. So we know that that is what's happening. So I'm going to circle back to one more thing. This is management's answer to that. We talked about it before, but I want to highlight it. It gets back to that net cash flow in the quarter. They said they were net cash flow positive in the second quarter. They're saying it again here in the third quarter. The idea should be that we're starting to see the growth rate, the improved underwriting, and still the acceleration of expenses is starting to kind of net out more positive for the business, where it's actually generating cash flow. Again, we've got a couple quarters. The second quarter was just a little bit positive, the $48 million here in the third quarter. Looking forward, the company doesn't specifically break out net cash flow or its cash flows in its guidance. But again, we look across the metrics. In-force premium is going to be up a chunk. Gross earned premium and revenue both are going to increase based on the quality and the improvements we've seen in their underwriting and kind of the trajectory of all of those things. The expectation should be another net cash flow positive fourth quarter, maybe even at a higher rate. If that happens, we should see that deficit in growth of assets versus faster growth of liabilities. We should see that narrow when we look at the balance sheet for the end of the year. So that's the thing I'm really going to be paying a ton of attention to, because Lemonade, they've improved the underwriting, but they've made a decision to accelerate spending on growth. They have to be able to afford to continue to do that in a sustainable way. That's the biggest thing I'm going to be paying close attention to. I encourage other investors that are watching the company to do the exact same thing.